All right, today we're looking at a 2-bedroom condo in North Carolina. This is 21 Meadowwood Glen Way, Unit D. So this is going to be a good one. Now, what I want to show is we're going to be looking at specifically this property, and we're going to look at whether or not it's a good property for a Section 8 rental. All right. So let's take a quick look at the photos. Now, for the most part, this property looks pretty solid. I mean, I would argue that's pretty much rent ready. There's no carpeting. There's 2 bathrooms. Not much rehab has to be done. So that makes sense for me. So the next thing I want to do is I want to quickly look up the rents. And I'm going to look at 2 factors. The most important factor that I look at is the payment standards and the market rent on this property. So let me copy and paste this. You go to affordablehousing.com, you go to the owner section, you go to the market rent estimator, you plug in the address, and you plug in a bedroom count. Now you're going to see that your average rent for 2-bedroom properties in this area is roughly $1,220 for 24 units within a 0.41 mile radius. Now, the thing here is that, well, if you look at what's actually going on and you look up, hey, if you look up Greensboro Housing Authority 2025 payment standards and you click on the first link, you can kind of scroll down right here. And it says right here that the 2-bedroom payment standard is $1,247. That lines up really well with $1,220 right here. So I'm pretty confident that the rent in this area is going to be $1,247. Now, usually the payment standards also includes utilities. So if you don't include utilities in your property, then you typically have to take the utility allowance by bedroom count, by type, so condo, apartment, etc., and find out what utility you're not providing the utilities for, and you don't have to subtract it. But in this case, this housing authority is very different. They actually give you the full $1,247 for rents, and I know that because I have other friends that are investing in Greensboro specifically. So you will get nearly the top of the housing voucher rent. Now, I probably won't underwrite with rental increases in the future years because, well, I've seen from the Housing Appropriations Committee and the Senate Appropriations Committee that they are likely capping the Section 8 funding. So it's unlikely that they're going to have that much more subsidies to increase it unless there is state funding available. So be very wary about increasing rents in your pro forma. All right, so let's go ahead and go through this analysis. So this property again is a property that's listed for $158,000. So let me get some numbers here. The taxes is 107 and the insurance is 62. So I'm gonna go to my underwriting right now, and I'm shifting it over here to my screen so you guys can see on Instagram Live a little bit easier. And this is how we're gonna go ahead and analyze this deal. So this property again is listed for 158. $158,000 that goes in B4. And again, if you want to copy the spreadsheet, you just go to affordablehousing.io, not .com. Go to the Get Deal Analysis tool, and that's the fastest for you to copy the spreadsheet. All right. So for my rehab, normally for single family homes, I would set aside $1,500 to repair any roof or patch it. But because this is a condo, I'm assuming that there are properties. There is a budget that's already been set aside, that's been approved to specifically help with funding roof repairs. So that doesn't apply here. For painting, I'll probably put about like 200 square foot just to kind of do some touch-up paint. I don't think there's any flooring work that's needed based on what I saw. For our toilet, we are going to do 2 toilets, and I like to replace my toilets with high pressure flush toilets. The reason I want to do that is because, well, guess what? If you ever get a call for a call toilet, that'll probably cost you $100, $200 for the service call. And if you replace the toilet afterwards, it'll probably cost you at least $200, $250. So I just think I must just do this up front, do it for about $450 and never get a call toilet call. That's my own personal preference. I've never gotten a clogged toilet call before, knock on wood, with my high pressure flush toilets. So I'm gonna keep it that way because people underestimate how much time you spend and energy that you spend solving problems that is no fun. So my monthly income rents, based on what we just talked about earlier, is 1247. That goes into B16 again. And dude, happy Friday, man. All right. So property taxes, get that right from a Redfin calculator. It's 107. For my insurance, equals 62. So I'm going to equal 62 times 1.2. And I always add a premium to my insurance number because I know that insurance companies view insurance premiums here or investment properties as a riskier asset. So I'm assuming that the $62 estimate on a Redfin payment calculator is for a primary residence. And because this is an investment property, I'm going to put up a little bit more. All right. So I got HOA dues for $235. Let's go ahead and do this. So for 235, I'll put it in right here in B34. For my maintenance in B32, I set aside 5% of my rents every single month for future repairs, right? I know that at some point the HVAC is going to get replaced or I'm going to have to replace a sink faucet or something. So I'm putting that money aside right now. And if you don't do that, right, guess what? You would be underestimating your expenses and overestimating your profitability because you don't set aside money, right? If you're a long-term buy and hold investor, you know you're going to get these expenses at some point, right? Something breaks all the time. So don't ever trust those gurus out there, especially in real estate that says, hey, my rent is this, my principal, interest, taxes, insurance is this, and that's my cash flow. Such a load of BS. I just think those people they're so fiscally irresponsible to be teaching people that. That really bothers me. So don't ever believe someone that says no maintenance. All right. I got 10% for property management expenses, and I got 5% for my property for my vacancy. And again, I like to put 5% in here because I want to be conservative, especially if for some reason there's a work requirement that comes out for Section 8, and all of a sudden, boom, people have to move out every 2 years. So you got to set that aside right now. You got to be conservative. Don't be so aggressive. Don't lie to yourself that this is a deal when it might not be a deal. All right. So the next up, I got 25% for my down payment. So my down payment is going to equal to my B4, which is my asking price times my down payment percentage. That makes it $39,500. From that point onwards, I got 3.5% for closing costs. I got $1,800 for my renovations that we talked about earlier. Very, very light rehab here. Now, in K6, my finance amount is going to equal to my B4, which is my asking price, minus my cash to seller. So I'll be financing $118,500. And that right now, I last closed the loan at 7.875% for an investment property. So I'll put that in right here. So what does this mean? If you rent this property out as a 2-bedroom for $1,247 right now, and you bought this property for $158,000, I like to put these numbers in here so that my partners already know how to analyze these deals. So I like to just put them in here. My rehab is 1,800, 25% down, 25% down, and 7.88% interest rate. I would cash flow negative $278. Right, that's right in B38. Right, that's right in B38. So let's play around. Let's say I'm looking for a 8% cash and cash return in E9. If I lower my asking price, let's just say to all the way to 100 grand, watch what happens to my cash and cash return. All right, 1.48. If I want to achieve an 8% cash and cash return, what do I need to buy this property by? For, I mean, you got to buy it for 75 grand. How about 78 grand? There you go. I want to buy this property for $78,000. Now, does that seem reasonable when it's listed for 158? Maybe not. But hey, at least now you know what your buy box is for this area within Greensboro, North Carolina, because this is the only way you can cash flow 157 after all your expenses, right? Now, let's do one more scenario. Let's say your interest rate just dropped by a full point, and this is absolutely possible overnight. Hey, thank you for joining, man. I appreciate you, brother. All right. So 6.875%. So if your interest rates drop by a full point, which can happen overnight, right? You have to understand what drives interest rates. If you ever Google relationship between 30-year mortgage interest rates and the 10-year treasury yield, right? You will figure out, hey, what's happening here? Now, historically, your spread, and just to be super clear, your 30-year mortgage interest rates are driven by two things. It's driven by the interest rate on the 10-year treasury yield, which is the Federal Reserve treasury yield bonds, and the spread between the 10-year yield and the 30-year mortgage interest rates. Now, historically, that spread has been about 1.5 to 2%. Okay. Right now, it's about roughly 2.42. It's gone as high as like 5.78 in the 80s, 1980s, but this is not the case anymore. So, for you to see a higher interest rate, what do you need to do to make that happen? Well, one, if you get good news from the trade deals that's happening, or maybe, and this is what I heard on the housing wire, maybe Trump has selected a Federal Reserve chair that's going to be incoming next year. And that incoming Federal Reserve chair can now start going telling people like, hey, I'm going to be lowering interest rates as soon as I get in office next year, right? Right when I get in I think it was like June or maybe it's May next year. Well, now people have anticipation of what's happening next year. So then the bond traders might start trading ahead and lowering the treasury yield as a result. That can happen. And that can drive half a point there and a half a point there. And guess what? All of a sudden, what does that mean for your buy box? If that goes down by 6.75%, the look what happened to the cash and cash return. It jumped to 9.83. So now all of a sudden, maybe I can pay 85. All right, that rounds up to 8. So now, because it dropped by a whole point to 6.875%, I can afford to pay 85,000 instead of the prior scenario of 78,000, simply because of interest rates dropping overnight. And that can happen overnight now because of how volatile the bond market is. So that's what I want to go through with you today, right? You want to change other factors? I mean, you can always adjust upwards the renovations, right? If you triple it, right? Let's say you go in and you found out that the plumbing needs to be replumbed. Well, all of a sudden, if you triple your rehab, your cash and cash return going down. So now you're forced to essentially lower your asking price again. So now you have to go back down to 81,000 as a ceiling price that you can pay for the property after your rehab tripled, right? This is how you adjust up and down your scenarios, your levers. So you figure out what is the deal for you. Because guess what? This is not investment advice. I'm not soliciting any investments on this call. I'm just simply showing you how to adjust the levers so that you can figure out what is a deal, quote unquote, for you and your situation. Because there's some people out there that will buy deals for appreciation, right? They'll buy properties for appreciation and they don't care if they might just want to break even on the cash flow. But if they're buying $1 million home, but it's appreciating 5% every single year, guess what? They're probably making like $50,000. So who cares about $200 of cash flow a month, right? They don't even care. They're making 50 grand. So it's a completely different strategy. But that's not to say you can't have that in your own portfolio and how you want to allocate your resources. Okay. Because some people have this like fancy word about strategy, right? And I define strategy as simply as you're allocating finite resources against an infinite amount of options. So you got to figure out where to spend your time and your money and your investments. So make sure that you're spending it wisely for your own goals. So that's what I want to go through today. All right. I hope this was helpful, everybody. Again, for you to figure out what is the right fit for you. Because if you don't, you're putting yourself in a very bad position. And you got to make sure you know your numbers and you understand how to put this together. All right. So I hope you all have an amazing Friday. I hope you spend some quality time with your family and friends today. Because that's what life is all about. All right. I'm so appreciative. Thank you so much for caring about affordable housing. Without people like you, I would have never had the home I grew up in. So I appreciate you all. Thank you so much for tuning to live. Thank you so much for caring about affordable housing. Thank you for trying to make an impact with your time, your energy, and resources, and just learning aside me. And thank you for letting me just make content about other things like generative engine optimization, all this stuff. So have a good one. I'll see you guys tomorrow for day 667. 667. We've been going live together for 667 days in a row. And my hope is this: you copy my homework, right? You analyze the same deal on Analyze Today using the same spreadsheet. Just go to affordablehousing.io, go to the Get Deal Analysis tool, and that's the fastest way for you to get a copy of the spreadsheet. All right. Oh, thanks, Don. I didn't even see you there. So have an amazing night. I'll see you tomorrow.